Well, Qantas is preparing for yet another overhaul, announcing plans to split its domestic business from its loss-making international operations. Yesterday, the carrier cut 500 jobs from its heavy maintenance facilities in Melbourne. Analysts say the latest move may help Qantas find partners for its profitable Australian service, but the future of local jobs remains up in the air. Neil Woolridge reports.
Assume the brace position, Qantas is splitting in two.
This is purely an internal change. The Qantas brand will stay exactly as is, the Jetstar brand will stay exactly as is.
From July, Qantas will run its domestic and international operations through separate business units. Each will have its own chief executive, although Alan Joyce remains CEO of the group.
The problem of having everything under one management is that perhaps the direct accountability, the costs and revenues of each activity isn't that effectively reflected.
The domestic service made a $500 million profit last financial year, while the international operations lost over $200 million. Analysts say the internal split will help Qantas find new alliance partners, but a sale of the international business is unlikely.
I don't think you could sell the international business. It doesn't make any money to start with. It would weaken the group's structure. That the domestic business would lose quite a deal of its strength if the international business were formally separated from it over time.
There's no room for Qantas to move thanks to the Qantas Sale Act and the great reluctance of the government to make any change to that. So Qantas, for example, cannot do what Virgin did a couple of months ago, and that is to split effectively into two companies, one a domestic company which can be wholly foreign owned if they want it to be.
Qantas International will be headed by former frequent flyer chief Simon Hickey. He's also been a director of Fiji's national carrier Air Pacific, which admitted last year to helping the country's military government draft a decree designed to crush the country's union movement.
The part of the business that needs help is the international business, and I don't think it's really a cosmetic change to their management.
On Monday, Qantas announced it would cut 500 jobs from its Melbourne heavy maintenance facilities. In a statement to the market today, Qantas says the internal restructure advances this essential program of change. It's unclear, though, whether that means further job losses.
Modern aircraft need less heavy maintenance and is often done in more sort of specialised and centralised fashion. So the notion of having a broad-based maintenance program in any one country is reducing.
Qantas shares rose almost 3% on today's announcement, although they're still trading near a record low and worth just a quarter of what they were before the global financial crisis. With jet fuel prices still high and the global economy teetering, it's going to take a lot more than a management shuffle to get Qantas shares soaring again.
Qantas falls firmly into that risk-off bucket. So when stock markets are going up like they are, say, today, then Qantas' share price will tend to go up in sympathy with that, not for any fundamental reason, but because there's a bit more risk appetite floating around.
The main casualty from the management reshuffle appears to be Jetstar's chief, Bruce Buchanan. Once thought of as a potential successor to Alan Joyce, instead he'll step down from his current post but remain as a consultant.